Thank you, everybody, for joining us on the offering webinar for FreeUp Storage Madison and Hartland portfolio. My name is Ryan Gibson with Spartan Investment Group. I'm the CIO. And before we get started, I'd like to get our disclaimers out of the way. We're not offering legal advice. Do your own due diligence. Consult your tax and legal team. And this is just a general overview of the offering. And you're encouraged to visit our deal room and go through all of our due diligence documents surrounding the investment. To access our deal room and the offering, you can go to our website, spartan-investors.com. Click on the investor portal up there on the top hand right, and you'll see that it'll bring you to a login screen. And if you don't have an account to enter your name and password, you can reach out to us at investors@spartan-investors.com for access, or to create an account right on this page, you can click the Create Account button. Once you get into the deal room or once you get into the dashboard, you'll see open investments on the top middle. And then you just click on the FreeUp Storage Madison portfolio, and that will bring you into the deal room that gives you all the documents there on the right that surround the investment. You'll find things like the underwriting file, our track record, the offering memorandum, wiring instructions, and a feasibility study with a PPM and the operating agreement for the deal. If you send a wiring instruction, or once you send your wires after subscribing, you can find the wiring instructions in here, and you can see them, and they give you a number that you can call and verify before sending wires, which we highly recommend that you do. To start the investment process and sign up, you just hit the Start Investment Process or Start Investment button, and it'll bring you to the subscription agreement where you can enter the amount that you wish to subscribe, and it'll also bring you to the accredited investor certification if you need to do that. For those that already have invested in Madison previously, that we'll cover tonight, to subscribe more funds to the deal, you'll find the actual investment under My Investments, and then the FreeUp Storage Hartland and Madison portfolio will already be under your active investments. So tonight, what we're going to talk about is the opportunity that we have for FreeUp Storage Madison and Hartland. Both of these properties and locations are Class A facilities in prime locations that have really strong market demographics. But before we get started, we're going to just talk about the team behind these two deals tonight. And this is our executive team, our CEO, Scott Lewis, co-founder. My name is Ryan Gibson, the CIO and co-founder of Spartan Investment Group. And tonight, we're going to also hear from Ben Lapidus, our Chief Financial Officer, who's going to be talking about the feasibility and the financials of the opportunity. Just a little bit about Spartan. We have an office in Golden, Colorado, and we were named the 5th fastest growing real estate company in 2020, and out of the Inc. 5000 magazine. And we were the 166th fastest growing private company overall. And our FreeUp Storage logo that you see there on the top right, that's actually the brand that we own and control and started last year that we brand all of our self-storage facilities in. We also have a small office in Seattle, Washington, and that's where most of our capital markets and investor relations team is based. So just to talk about our team a little bit more, we have about 70 employees, and we handle everything in the deal process. Our team is fully vertically integrated. So we do acquisitions, capital markets, which is procuring the debt. We do syndicated equity with our investor network. And we have our construction team, Spartan Construction Management, who handles all aspects of the construction, ground up development through initial improvements on all of our assets. Asset management of the facilities. And then we also do all of our own property management. So this means that we actually employ all the property managers and store managers at our properties. We train them, and we do all of our property management under the FreeUp Storage national brand. Spartan Investment Group has about 17,000 active units across 9 states. We have about 70 full-time active employees, 400 million of assets under management. We have about 500 active investors, and we've raised over 140 million of private equity, and we've got 10 projects. And speaking of those projects, if you go to Verivest, we're actually a Verivest verified gold sponsor, meaning that a third party has audited our track record, tax returns, financial statements to verify that we actually have 10 full cycle projects and verify the profit in those projects. So if you go to Verifest, you can find all the information on our full cycle deals. This is our portfolio that we currently have across the United States. And the reason why I spend a little bit of time on this slide is to show that we have about 50 store locations across the United States, spread across nine states. And Spartan's goal is to build a $1 billion portfolio. We're about halfway there, and we expect to be at about $1 billion by the end of 2022. And, a lot of investors ask, why, how does that benefit me? What does a $1 billion portfolio do to my investment, or how does that help me and my particular deal, whether it be this Wisconsin deal or a Texas project? And the reality about the situation is that there's a lot of money pouring into the self-storage space. Public Storage just recently picked up $3.3 billion worth of new portfolio assets that are in the self-storage. Blackstone bought Simply Self Storage for $1.2 billion. Bill Gates just became part owner in one of the largest operators, StoreMart, this past year. Inland Private Capital Group just bought a $265 million, or they just sold a $265 million portfolio for about a 3.5 cap, and Simply just picked up another portfolio in Houston and Dallas, and it just keeps going and going and going. And these are all just big portfolio transactions that have happened in the last year. CubeSmart being more recent with a $1.69 billion acquisition. So, when we build a $1 billion portfolio at Spartan, we're not, our number one exit strategy, or even our number 5 exit strategy, isn't to sell a portfolio of assets. It's to have optionality. We want to have exit strategies that are abundant and flexible given the situation that the economy derives or the market drives, right? And our exit cap rate on this particular investment tonight is a 5.48%. And we actually show the cap rate getting worse throughout the life of the investment, not because the deal gets worse, but because we think that if we want to be conservative, that if the market goes down, we're in a position where we can still offload the asset and hit our projected returns. So with that 5.48% cap rate, our annualized blended return across Class A and B shares is about 18.1% annually. In the big portfolio sale, it's likely that the cap rate is going to drop to 4%. And what that would do to your return is projected returns would go up to around 31% annually on the blended Class A and B share. So if you're wondering, what is an advantage to investing in an operator with a large portfolio or plans to accumulate a large portfolio, it increases your chance of a higher return than what we project on the exit. So tonight, what we're doing is we're talking about 2 facilities, one in Madison, one in Hartland. And these facilities are both about 56 miles away from each other. Here's a few photos. They're the best top of the market assets. So you can see the Madison facility, really nice brick facade, metal construction. And then you have the nice metal and brick construction on the right there, Benchmark Storage in Hartland, Wisconsin. These facilities are top of the market, best in class trophy assets. And so some of the investors on the call tonight are already invested in the Madison property. And what we wanted to do is kind of go through sort of the story of how these 2 properties came together to create this new offering. So the original offering was FreeUp Storage Madison, and that was closed on August 6th of 2021. So just a few months ago. And it was a really nice facility. It's been cash flowing about 7 to 8%, and we've been making monthly distributions. And all of a sudden, we had the opportunity to buy FreeUp Storage Hartland, or the Benchmark Storage today. And they're both similar vintage facilities, both Class A properties in really strong market demographics. And we evaluated, hey, what if we ran these together as a Wisconsin portfolio? We would combine a lot of efficiencies, and we underwrote combining these 2 assets together. And what we found is when we combined this offering together, we were able to leverage operational efficiencies and spread the risk between 2 really strong markets. So what we did was we amended the offering to include Hartland And now we're going to market to raise approximately another $2 million to buy the Benchmark self-storage. And what we love about Benchmark is that it complements the Madison diverse unit mix. So if you notice, this property has a little garage door on the side of it. And as you guys know, it's pretty cold in Wisconsin and it snows a lot. So what our customers really enjoy is that that garage door can open up and you can actually drive into the facility, offload your belongings, be out of the elements, and go up an elevator and access any one of those 3 levels from the interior of the building. What we also like is the Madison property has some very unique features to it. Our customers love drive-up storage. And this drive-up storage here is not only just your standard drive-up storage that's convenient from the main road, but it also has a unique garage door on it that's insulated. So these are actually drive-up heated units. What's also interesting about Madison is that there's actually a moratorium on single storage development. So we've been grandfathered in to expand this property, but the market actually doesn't allow you to build any more of this nice drive-up storage. There's a moratorium on it. So even if somebody came into the Madison market and wanted to build more of this, they wouldn't be able to. So this is a really in short supply, the single story drive-up units. The other thing that we like about Dane and Waukesha County is that they are the highest net migration counties in the state of Wisconsin. Dane being number 1 and Waukesha being number 2. So we have the highest growth markets in Wisconsin and the best assets within those markets. We are expanding Madison by 20,000 square feet. And although there's a moratorium, we've been grandfathered in and granted permission to build a 20,000 square foot expansion. We're planning on doing this all heated units or climate controlled. And there's a moratorium, as I've stated earlier, on single story storage development. What we love about the Hartland location specifically is off on a main highway, and it gets over 15,000 vehicles per day. That's what that VPD stands for. And it required a conditional use permit to build it. The facility was actually only built in 2018, and it went under strict design standards. And Spartan has been through this process, and it's a very difficult process to convince a nice, high, strong demographic town to build a self-storage facility. So it goes through some pretty strict design review. We had to build, we're building one in Sandy, Oregon, which is just outside of Portland, that undergone some of the same standards. And it took 5 years in permitting to get it approved. And then also we have a facility we built just south of Seattle that took over 4 years to get approved. And it's because of the design standards that are placed on some of these properties. That's beneficial to us because that limits our competition or requires a high barrier to entry on a new facility being built up to the standard that's required. The other thing about these properties is we have 3.57% financing on Madison. We have an 18-month interest-only loan, and it amortizes to 30 years. So we actually have really strong financing in place on the Madison property. And likewise, on the Hartland property, we got a 3.65% fully approved loan to finance the Hartland facility. The interest-only period on Hartland is 12 months, so 18 months on Madison and 12 months on Hartland, respectively. And that delivers a very healthy 2.04x DSCR on our first year on our debt service coverage ratio. So it's very strong. What we really like is that, we're combining these two facilities, and we have combined payroll, we have combined travel expenses, and we can really start taking advantage of reducing our payroll and using automation and contactless bookings to make these two properties very efficient within the given market. This is just talking about the cash flow. So this is based on a $50,000 investment, and it's a 4-year target hold. So you can see in the first year, we have a cash flow projection of about 3,309. That's a 6.6% cash on cash return. And in the second year, it drops just a little bit because the interest only period burns off on the loans, increases slightly in year 3. And as we deliver the expansion in year 4, we have an increasing cash rate of 6.5%. You also share in the sales upside of the deal. And so 45.1% of your return comes from the profit in year 4. So in total, the performance is a 67.6% return over 4 years. And that, like I said earlier, the hold time is a 4-year hold. Let's talk about bonus depreciation. So the tax code changed in 2018, as you are very well aware, and we get to order a cost segregation study that goes out to the property, and we can take pretty heavy losses from bonus depreciation for the tax year 2021. So if you invest by the end of this year, you can take advantage of bonus depreciation. And so here's how it works. Let's just take the example of 4 years of cash flow. 4 years of cash flow on a $50,000 investment is about $11,225. We're projecting that our bonus depreciation in the first year on these assets is going to be about $19,600 per 50K invested. So what that means is the cash flow in year 1, year 2, year 3, year 4 is all shielded from bonus depreciation. Now, I always like to disclaimer that I'm not a CPA. I'm not giving financial advice, so please do your due diligence and talk to your CPA or financial advisor about these methodologies. So lastly, before I turn things over to Ben, we're talking about the operational improvements. What does Spartan's team do under the FreeUp Storage brand? We go in and we rebrand these properties. We put our signage, our marketing, and our website to these properties to increase the SEO, the Google AdWords. We do a lot of different things to strategize and reposition these assets so that we can lease them up. We increase rents to market, and we train our staff to enhance the customer experience. We develop deep relationships in every market that we do to get some of that local organic marketing. Business relationships, because 30% of our customers are actually from businesses. And then we add ancillary revenue streams through tenant insurance and retail sales. And if you're familiar with self-storage, tenant insurance is a big revenue driver in our portfolio, and we require all of our tenants or customers to have tenant insurance. If they use our provider, we get about 50 to 60% of the revenue share with our tenant insurance provider, adding instant ancillary revenue to our properties. So with that, I'm going to go ahead and turn things over to Ben Lapidus, our Chief Financial Officer. And he's going to run through 2 sections. He's going to run through the feasibility of what makes these great markets, and he's going to run through the financials that he has put together for this opportunity. Ben, take it away.
Awesome. Thanks, Ryan. All right, folks. Well, we're first going to walk through the feasibility of our evaluation of these 2 assets and the 2 markets that they're in. So let's start with Wisconsin. If you like cheese, if you're a lactose lover like me, you can thank Wisconsin. It's America's dairyland. It produces 1/4 of the nation's cheese and butter. It's also an economic driver. Its economy is driven by agriculture, healthcare, diverse manufacturing. Fortune 500 companies include Northwestern Mutual, Harley-Davidson, and Kohl's. The state grows more than half the nation's cranberries and ranks first in nationwide production of paper products. So a lot of really fun things coming out of the state of Wisconsin. If we're talking about where these 2 transactions came from, the first one, Applewood Self-Storage, which we've rebranded to FreeUp Storage Madison, came from one transaction. It closed on August 6th, 2021. We were actually not the highest bidder on this transaction. We had a somewhat inside track from the broker at CBRE. We've got a great relationship with them. And we were able to take this deal down and close it with a little bit of difficulty with the seller, but we got it done on August 6th, and it's been cash flowing, like Ryan said, about 7 to 8%. What's more interesting is actually how we won the second deal on the next slide. The seller of Hartland actually saw a picture that we posted on LinkedIn of our company being taken out to a baseball game, a Denver Rockies baseball game, to celebrate one of our team members' 2-year anniversary. In fact, if anybody on this call has talked with Lauren Brichelle, it was her 2-year anniversary. We took the whole team out to a baseball game. We posted on LinkedIn. They saw our offer, and we won the deal because the seller wanted to sell it to real people, which is fantastic that we didn't get into a bidding war because we showcased our culture on LinkedIn. So we're closing on this transaction December 21st. It's been one of the smoothest due diligence transactions we've had to date. I saw the buyer settlement statement today, 5 days before closing. And as Ryan could attest, we typically don't actually see the settlement statement until the day after closing. So it's been incredibly smooth. So let's talk about the Madison market. It's the state capital, the second most populated city in Wisconsin. Major employers include Epic Systems, which is a healthcare company, the state government, as well as University of Wisconsin-Madison and its hospital system, which employs over 22,000 people and has a student enrollment of over 45,000. It's got an incredibly cool growing startup scene. And when I say cool, I come from a previous life of the tech industry. And when I did this trip personally to assess the feasibility, I saw the rovers for pizza delivery, the little rover dogs that do automated pizza delivery being pilot tested around the university, which I immediately asked, why is this not in Denver yet? So that's just an example of how the University of Madison, Wisconsin has fostered both technology and entrepreneurship and has become a beacon of industry, of startup industry. It's also got over 10,000 housing units in the pipeline within 15 minutes of our facility. And home prices have appreciated by over 7%. It's also got the lowest unemployment rate compared to state and national averages, which we love. And moving on to that next slide. Oh, yep. 10,000 housing units in the pipeline within a 15-minute drive radius, which is quite a bit, 10,000 housing units. It's also got a very large redevelopment, a 5-year master plan that's expected to open next year for the city of Madison. And they're anticipating it's going to attract over 500,000 visitors every year. So it's continuing to become a hub of population and excitement and energy for the city of, for the state of Wisconsin. I wanted to put these two net migration slides right next to each other, even though we haven't moved on to the Hartland facility. So you can see on the top that Dane County, which is where Madison sits, is got the #1 net migration for the state across the few dozen counties in the state. And it just so and there's over 35,000 people moving to Dane County each year. And interestingly enough, that second dot on the first slide is Waukesha County, which is where Hartland sits, right outside of Milwaukee. So even though it's one county away from Milwaukee, Milwaukee County being the lowest net migration county in the state, a suburb, very affluent suburb of Waukesha County, struggling to say that county's name, is the #2 net migration. So what we love about the Hartland market is, I'll start with the financial components, and it's really what drove us to this market to begin with. There's over 100,000 median household income in the area, in the city. That is not the average salary of every person. That is the household income. The nationwide household income is just over half of that. So that is a significantly high median household income. 1.55% annual income growth, that's per year. So we're looking at close to a 10% income growth over the next 5 to 6 years. And home values have increased nearly 50% just in the last 4 years. So like the rest of the country, it is keeping up with cities like Denver and Seattle and DC in home value increases, but it's Hartland, Wisconsin, the town that, unless you're from Wisconsin, you actually haven't heard of. So the affluence of this town is increasing drastically. In addition, it's got lots of growth outwards from Milwaukee proper into surrounding communities. It's got over 300 new residential units in progress. That's actually 3% of the current town's housing supply. And that's all I have to say about Hartland. So moving on to the overall occupancy of these two markets, Madison's market occupancy is 97% and Hartland's market occupancy is 99%. What does this mean? This means that we either called or went into every single facility. We didn't get answers from every single one, but the ones that we did get answers from, we were able to get their rent roll, and we assessed primary data on what the exact square footage occupancy is of the market. This is not some third-party data provider. This is not us making a guess. This is us assessing granular data by calling the managers, the owners of each of these surrounding facilities. An average market occupancy of 98% is very high. The industry standard is stabilization is considered to be at 85%. And even with the incredible increase in occupancy that we've seen since the start of COVID, the average market occupancy is averaging between 92 and 94%. So for both of these deals to be floating around 98%, it means one thing. It means that the overall rents for the market are not high enough. That is not necessarily about our facility, but the overall rents for the market are not high enough, and the market rents should be and will be pushed. So how does this compare to our facilities? There's a market, an occupancy increase of 24% that could be achieved in Madison to meet the market occupancy, and 16% in Hartland. And why are these two below the average market occupancy? Shouldn't that be a flag to consider, and you're absolutely right. The reason is because Madison was expanded in 2019. It was actually its second expansion, and Hartland was built in 2018. So it's achieved Hartland specifically has achieved 83% occupancy for the facility in about 3 years, which is appropriate. That's a good lease up. So the biggest part of our business plan here is really just finishing the leasing in these strong markets. So we're going to dive into some of the underwriting assumptions and how we're coming up with our target returns. Wanted to call attention to the fact that the underwriting file, along with the feasibility studies, there's 2 feasibility studies, can be found in the investor portal. You can dive into absolutely everything that we have accumulated for your review. So the overall business plan for almost every one of our self-storage facilities is threefold. We increase the collections on the existing customers. This doesn't mean increasing the street rates on the existing customers. It means taking these customers that might have as much as a 50% discount on their unit compared to a new tenant coming in, getting their rents up, or actually collecting on the rent instead of letting them sit there without paying. Or it means getting rid of the discounts. So step 1 is increasing collections on the existing customers. Step 2, which in this particular business plan is not a strong component, is increasing street rates. And when there is an expansion play, like there is at one of these facilities, the Madison location, we also can drive revenue growth through an expansion. So if we break this down, our revenue growth plan starts with increasing collections, decreasing delinquencies, decreasing discounts, and decreasing loss to lease. And this is going to generate a 37% increase to our collections, which is about 2/3 of our overall business plan for driving revenue up. So this is the most significant opportunity, is just getting these facilities to lease up at the same standards as the competitive facilities, which are lower quality. So there is a history of lease up. These are the nicest assets in the market, and they're below market occupancy. We just have to continue doing what has been done to these facilities. And if we can do it even better than the previous owners, which we expect to, then that'll be great. So this accounts for 2/3 of the revenue growth plan. The other 2 components, which includes increasing the facility street rates, only accounts for about 5% of our revenue growth assumptions. So for the most part, we're assuming on average that we're going to be keeping our street rates pretty much the same. The Hartland facility, there are a handful of units that are already fully leased up. So we're actually going to be pushing those rents by over 13%. But on average, it accounts for about 5% of our revenue growth plan. The remaining 27% of our revenue growth plan comes from the expansion at Madison, which is approximately 20,000 square feet. There's also a conversion component. There's a 1,300 square foot unit that we're going to be converting into smaller units. So that's on the revenue side. On the risk side, there's a few pillars of risk that are associated with commercial real estate, especially with self-storage. And self-storage has been a massive target for property tax reassessment for good reason. 10 years ago, self-storage facilities were worth significantly less than they are today. It wasn't an institutionalized asset class, and it now is. So every county around the United States is taking advantage of these property values that have increased nationwide. Not to say that the ride of appreciation is over. We're going to get into that in our cap rate conversation. We believe that there is still plenty of room to go on value increase. But the property tax consideration is important. And in the state of Wisconsin, if anybody's telling you that they're going to reassess a Wisconsin facility to anything less than 90%, they don't know what they're talking about. We have been reassessed in 9 states. We have fought in 9 states, and we've learned the unique dynamics of the law in each of these states, and won more often than not. So in the state of Wisconsin, we don't mess around. There's not a lot of flexibility, not a lot of latitude. We've assumed a reassessment of about 95%. On average, it's about 82 to 88% of the sales price. So we've got a significant property tax increase that is a conservative percentage of the sales price in terms of reassessment. The second risk component is, how are you capitalizing yourself? What is your debt? So we actually underwrote our underwriting. All of our targets are based on the 3.75% interest rate. That was our assumed target. We achieved better than that. However, we had already packaged up our underwriting file and our security based on the original numbers. So there is some efficiencies here. We locked in our Hartland financing at 3.65%, and we achieved a 3.57% interest rate on the Madison facility back in August. These are both locked in. rates, fixed rates. The interest-only period is 18 months and 12 months, respectively, Madison and Hartland. And the amortization is 30 years on the Madison facility and 25 years on the Hartland facility. So we have a 2.04 debt service coverage ratio in that first year where we're interest only. Our debt service coverage ratio does not dip below 1.5 at any point throughout the life cycle of this investment targeted. So compared to the 1.25 to 1.3 debt service coverage ratio that banks like to see, we have a very healthy debt yield and risk consideration on our capital stack. And the last major risk component is cap rates. And I have seen a couple of questions already start to come in about cap rates. So I'll answer one of those here. I know that Ryan has already started to answer these in the Q&A, but when we look at the cap rates for the future, they are somewhat related, more than somewhat related. They are tethered to a certain extent, not a 1 R-squared, not a 1 correlation, to interest rates. And with the interest rates hikes that were just announced this week, are we worried about cap rate expansion? The Fed interest rate hikes is something that we've been worried about for 3 or 4 years. So we've been underwriting cap rate expansion for 4 years. So we've got lots of assets that we underwrote cap rate expansion at 5.5, 6, 6.5 cap rates that grew by 20, 30, 40 basis points along a 4, 5, 6 year hold. And we've only ever seen cap rates compress, even with slight interest rate adjustments over the last year, year and a half. So will the Fed interest rate hikes for next year be enough to start kind of pushing cap rates in the other direction? And over the last year, year and a half, cap rates have come down even as interest rates have gone up. And that's driven by investment supply and demand. With all of the tens of billions of dollars that have entered the self-storage space since December of 2020, cap rates are going to continue to compress even with minor interest rate hikes. At some point, it will level out. The spread cannot be compressed too far. Otherwise, investors are going to look for yields in other places. But that spread has not been compressed to be comparable with other asset classes like multifamily. There's still a larger spread between cap rates and interest rates in the self-storage space than there is in the multifamily space, even as self-storage is becoming a darling of the commercial real estate industry, it being the top performer of all commercial real estate asset classes over COVID, and it becoming apparent that it is a recession-resistant asset class over the last 3 recessions. So we are anticipating some type of cap rate expansion in our underwriting. We're not 100% confident it actually will happen. And the reality is that interest rates only affect cap rates in the short term because interest rates are pushed by the Fed in response to inflation. Inflation drives up rents, rents drive up your NOI. And so even if your cap rate goes up, your NOI is also going up. And usually there's about a 1 year, 15-month lag of those rents catching up so that you're getting the same value even with those interest rate increases. So that's our overall economic thesis on cap rates. But we've underwritten a 5.5% cap rate exit. We are purchasing this at 5.4% on month 1, T3 trailing income. So a 5.5 cap rate expansion compared to a 4 to 4.5% overall anticipated cap rate exit on a portfolio, we deem that to be on the more conservative side. So just to wrap up what all of this means, all of this underwriting means for an investor, the minimum investment amount for Class A is $50,000. For Class B, it's $1 million. For every $50,000 investment, there's going to be 0.28% ownership of the entity that owns both assets. For Class B, there's a 20% kicker on ownership, meaning that there's 20 shares of that 50,000 inside of $1 million, but there's 24x the ownership, 20% more than those 20 shares. It's a little bit confusing the way I just phrased that, but there is more ownership per 50,000 in the $1 million class than there is in Class A. Both have the same 7% preferred return. So the total operating returns for Class A over the 5-year hold is $11,000 with sales upside of $22,000. So 2/3 of the overall returns are coming from the liquidity event, and the other third is coming from the cash flow. Similarly, on the Class B side, $224,000 coming from the operating returns and $540,000 from the sales upside. So a little bit more than 2/3 in Class B, and that's because of that equity kicker. So there's even more liquidity proceeds. So the total return for investors in Class A is 67.6%, which works out to 16.9% annualized. That's a 1.68 equity multiple. On the Class B side, the annualized return is over 19%, which is a 1.77 equity multiple. In our underwriting file, you'll see the back-end calculations of our monthly P&L, our annual P&L, our exit assumptions for 3 different scenarios. We like to bookmark our returns based on a couple of the key metrics that have the largest swings and volatility inside of an underwriting file. Things like, what's your maximum economic performance ceiling? We're not going to assume 100% economic occupancy. So if you move that by 2 points, 88, 90, 92%, what does that do to your underwriting? We take cap rate swings, hold period swings, lease up assumption swings, amongst a handful of others. And so even though our Class A returns are targeted at 17.6%, we're bookending those returns with a fairly high level of confidence that will land between 10.8% and 27.8%. And this does not include any gravy that might come from portfolio compression. So with that, I will turn it back over to Ryan to take us home.
Thank you, Ben. Really appreciate that thorough overview. And we're going to open it up for Q&A here in just a minute. We've got some great questions that we've already answered, but we'll answer them live as well. The next steps are to subscribe on our investor portal. You can go to Spartan-investors.com that you can see up here on the screen to log into the dashboard and subscribe. And if you have any problems whatsoever, you can email our entire team here. We have about 5 people on our investor relations team at investors@Spartan-investors.com. And funds that are received begin accruing the 7% preferred return right away, since we already own one of the assets. And funding is likely going to be open through December. I did want to point out that if you did want to take advantage of bonus depreciation, you'd have to invest by the end of the year in funds transferred to take advantage of the $19,000 or so per 50K investment. Otherwise, it will go into the new tax year, and that window is kind of missed. So with that, we're going to go ahead and open it up for Q&A. So I wanted to thank everybody for coming out, and we're going to go ahead and look at a few questions and answer those live. All right, so the first question that we have tonight that we've kind of already answered, Ben, if you wanted to go ahead and just start looking at the combined trailing 12 NOI for the properties and the cap rate on trailing in place NOI based on the purchase, that would be great. And I'll go ahead and run through a few of the questions that I can answer here. And that is bonus depreciation only available to real estate professionals? And this is a great question that you should chat and discuss with your CPA. But also, my understanding is that anybody can take advantage of bonus depreciation against your passive income, right? Or you can use passive losses against passive gains. If you're a real estate professional, that may open up the world of applying it against ordinary income and other things. But I would definitely consult with your CPA. But my understanding is that anybody can take advantage of bonus depreciation against passive gains or passive income. Okay, next question I have is, any concerns with projected profits being impacted by new policies the Fed announced or will be happening next year? If property values decrease, would Spartan hold off on selling until it hits its target price? So we're always, good stewards of the investment. We're going to make the best decision based on the market conditions and kind of where we are with the asset. But at this time, we don't have any open or outstanding tax bills or laws that would impact CRE or this investment in particular. But that definitely is a risk for any investment that you make, any investment, whether it be with Spartan or another operator, or any investments that you're making in the stock market. Those risks would be applicable, but we don't have any on our dashboard right now that are threatening the projected profits of this investment.
Just to add on to that, Ryan, only because I think the question was about interest rate announcements from the Fed this past week, which we did answer a little bit during the webinar. But to answer the question of would we hold on to the asset, we reassess the value of the asset today versus the future value to determine what the IRR comparison is going to be on a regular basis. So it's going to be open. It's going to depend on where we're at and our economic theory for interest rates and other factors, how it can impact the future value.
Great. One question that I have is, are we going to be 1031 exchanging the profits from the sale into another property to keep the tax savings going. And that is our plan. A lot of things get in the way of our plan, tax code changes or just circumstances, or maybe when we go to sell the property, we won't have something to 1031 exchange into, but that's our plan. Our intent is to 1031 the partnership into another deal and keep your tax savings rolling. And what's great about that opportunity is that people can kind of jump off. They can kind of decide not to roll up. And if you decide to stay on, you can go into the next investment, and we would give you that option. Next question that I have is, for some reason, I thought the offering doc indicated that the monthly payout would be 7%. Based on what you just showed, it looked like the highest would be about 6.5% for a monthly payout. Did I misunderstand the 7% monthly payout average? And the answer is no, you did not. You didn't. The preferred return in this investment is 7%. So that means that an investor owns the first 7% of profit that would be distributed on this investment on an annual basis, and that's cumulative and rolling, meaning that if we get to the end of the investment and we haven't hit a 7% return every single month or every single day, we would have to make up that 7% before any profit split with the general partnership or with Spartan. I'll give you a great example. We're actually refinancing a property that investors have been in for just a little bit over 2 years tomorrow or Monday. And that investment actually was a little bit shy of the preferred return of 8% for 2 years. And when we refinance, we're actually going to have to pay down that preferred return account balance before any money goes to the GP. So the investors are getting caught up for any deficiencies in that 8% before any split with the partnership. So it's a really nice advantage to the limited to the investors to have that preferred return in there. But with any syndication or any private placement, don't confuse preferred return with the actual cash on cash that comes out. In this case, it's slightly below the preferred return. For comps, how did you get the owners to give you rent rolls? Sometimes we walk up to the counter and we make friendly conversation with people, and they literally will take their entire rent roll and just slide it across the counter and say, this is what I have, and this is what I don't have available. Some people, we have to be a little bit more crafty and mystery shop, but we get all of our rent rolls, kind of our occupancy data from going in and physically mystery shopping the facility. We go to all of our properties. Our team is dispatched out there and we do mystery shopping. We also use data for that as well. Another great question: is depreciation spread out evenly across the years, or is there a larger chunk in year one? The answer to your question is we're projecting about a $19,600 depreciation loss per 50 in 2021. However, in subsequent years, there's still depreciation, but just not as much. The reality is that the parts that we can't bonus depreciate or cost segregate are the building, right? So the building in commercial real estate is a 39-year depreciation cycle. So there's going to be some depreciation given to the department, to the partnership, and to you, the investor, in the subsequent years, but it's going to be very small. The next question that we have is, Ben, you want to answer those cap rate questions from earlier, and then I can kind of look at the next questions?
Yeah, so I don't have the seller's information in front of me, but using the seller's revenue data against our operational model, the cap rate at purchase is 5.4%, and the NOI is 1.27 million annualized on a T1.
Very good. Can you get bonus depreciation in 2022 if you invest the 1st of January 2022? And I don't think so. I'd have to check with my CPA, but I think the answer to that is no, Mike. So sorry about that. So the other question was, I just answered it, so it went away, but is the depreciation if I invest this year in 2021? And the answer is correct. That's yes. Ben, if you want to work on the LTV ratio, unless you have that off the top of your head.
Yep, it's 70%.
Okay. And I believe that takes us to the end of questions. If I missed your question, please refresh to the top. I didn't mean to skip you. I just, I feel like I've answered everything. Waukesha. Thank you, Greg. Waukesha. We practiced. It's tough.
Yeah, Ryan and I looked up the pronunciation earlier today, and we were practicing with each other. Still got it wrong. I did.
I should know that my family's from Appleton originally, so I should know these pronunciations. But okay, any questions? Any final questions? This will be recorded and sent out to all of our investors within 24 hours. Okay, we've got a question from John. What is the purchase price of Hartland? Is that $8,050,000, Ben?
I believe so. I believe that's correct.
Okay. It's also, I believe, in
That's correct. 8,050,000.
Yeah, 8,050,000. All right. Final call for questions. All right. Well, we wanted to thank everybody for attending the webinar this evening. This will be recorded and sent out, and we look forward to potentially working with you. Thanks, everybody, and have a great night.